Salanche estoinche. All right, that means health and wealth in, I guess in Gaelic. It's St. Patrick's Day. Can you tell? I got the green on. You know, we're having a little fun. Thanks for joining me. This is Demel Gonzalez of Heartwood Financial Services. If you're the first time here, I'm usually not this corny. Get it, corny? Maybe I should delete that. No, we'll leave it in there. But welcome. If you've been here before, welcome back. You know, go ahead and hit like, and if you haven't been here before, subscribe, hit the little bell. That way you know when all the latest stuff comes out. But again, welcome. This is our financial education video on market corrections. All right, now let's get serious. Market corrections are ugly. They can be scary. So we're going to talk about what they look like. What's the difference between a correction and a bear market? What are you supposed to do? Can you time this? What is the best strategy to take? So I hope you guys enjoy it and stay tuned. All right, let's get right into it. The gist of this educational video is to give you some perspective on corrections that occur in the stock market, how often they happen, and the temptations that we can get, you know, in trying to time things, right? So, and I'll show you a little bit more of that in the other charts. But this chart here, for starters, is giving you some historical perspective on the stock market. And you can see the gray lines are the total return for the year. The red dots are the intra-year lows. So you can see, like in 1980, the market was up 26%, but it was down negative 17% at one point. And as you can see from all the red dots, is that there are corrections very frequently. Corrections are anything more than a 10% drop, but not more than 20. Because once you get over 20, then it's considered a bear market. And we've had a few of those. You can see those here, you know, minus 34, minus 20. So we're not in that zone yet. Usually bear markets happen when the market's anticipating a recession. So right now we're at a minus 12. That's kind of the low point for the S&P 500. So we're in a correction territory, not in a bear market. So obviously the market's not pricing in a recession yet. If it goes down more, that might become more and more likely. I personally am not in the camp of seeing a recession that's imminent. Depending on how long this thing goes with Russia and the inflationary pressures that it's adding on to the already existing inflationary pressures. I did think about my personal perspective on this. I've been in the business basically since 1998, and I've seen basically about 18 corrections, okay? And as you can do the math, that's about 24 years being in the business. So as you can see, again, these things happen very frequently, and you can even argue that they're pretty healthy because the stock market was getting a little pricey from its price compared to the earnings perspective. So you can argue that this is healthy, and of course, unless there's some sort of big war, and inflation doesn't persist for at this level, because we just had a 7.9% CPI report yesterday. At this level for the whole year, we probably won't be going into a recession, and we'll probably just be looking back to this as a correction. Okay, this next slide is really emphasizing that little itch that we get when we see the market go in corrections. We get that itch to maybe want to sell some things to kind of relieve the pressure of, you know, the market going down and trying to stop from losing money. And what I want to show you here is it could be dangerous to think that we could try to do that. So the title of this, it's not about the timing, it's the time in. All right, I said it backwards. It's about the time in, not the timing. I should read my own titles. Anyways, you can see here when you look at the chart, this is again the S&P 500 going back to 1989, basically starting at 1990. So it's a little bit different time frame than what we were looking at with the JP Morgan chart before. So 1990 to the end of last year. And this is really pretty interesting. If you see that buying and holding the S&P 500, you would have averaged about 11%. But if you would have just missed the best 5 days or 10 days or even 20 days, you can see how your total return goes down dramatically, okay? And this is since 1990. This is 30 plus years, folks. So in 30 plus years, if you just missed the best 10 days, you would be returning 2% less. And even when you go down to the missing the 25 best days, which is less than 1 day a year in this example, you'd be earning about what the bond market performed during that same period of 1990 to the end of last year. So that's the big shocker. So the reason that that's the case is because a lot of the biggest moves in the stock market happen during bear markets and during corrections. And they can happen very, very quickly, big pops in the middle of these turbulent times. I know a lot of times we think that the market goes up little by little, and that is usually the case when it's a normal market environment and we're kind of in an upswing. But when we're going through tumultuous times, through corrections and bear markets, the market actually has huge up days. In fact, that's when it has its biggest up days. That's why it's so dangerous to think you could sidestep the market by going to cash and trying to time going out and then getting back in, which is a whole other story. But you can see by this chart that that is a very tricky maneuver to try to pull off. Okay, so if you didn't believe me with the first chart, I'm going to show you a second one that essentially shows the exact same thing. Does a little different time frame. This one goes back all the way to 1980, not just 1990. And instead of a percentage, it's actually a dollar amount. You invest $10,000 in the S&P 500, you would have been up to $708,000 during that whole time. If you would have missed the best 5 days, 458. The best 10 days, 341, which is about half, right? And then if you miss the best 30 days and 50 days, it makes a gigantic difference. So again, this is the danger in trying to time the market. There's this whipsawing effect that when the market is taking big hits, it comes back very quickly and adjusts very quickly during these times. And that's the time when you can really do some damage to your portfolio by not just having that patience and hanging in there. Make sense? Okay, here's the bottom line, guys. I know I'm human. We have emotions. We get a little ruffled when the market's down, especially when it's down 10+%. It starts getting a little scary. I totally get it. You're tempted to maybe get out of the market, try to time it. It's completely normal human behavior. Good investing is not normal human behavior. It's hard. It takes discipline. It takes understanding the historical perspective, looking at what's happened in the past, having a plan. So this is why I wanted to bring up this little section here. And the best way to ensure yourself from making these mental errors when you're investing and trying to do this timing is by having a plan. In other words, what is the proper asset allocation that you need to have to begin with to meet your goals, to make sure you have the income that you need based on how much you're saving, what you're comfortable with. All these things need to go into a financial plan. Have that mix. Then have a strategy of how you're going to manage that mix. Maybe it's rebalancing. Maybe it's something else. And so this is what's very important to have, put it down on paper. Talk to somebody else about it. Have somebody that you're kind of accountable to. If none of those things are very good for you because you know yourself and maybe you've tried it before, maybe that's when you can hire a professional, somebody like a financial advisor, somebody like me, somebody that's a certified financial planner that's familiar, that's been through these cycles before, that has a plan, that's looked back and thought, all right, what worked back then and what could work going forward? What is different? What should we tweak? All those types of things that we need to consider. So make sure if you're not working with somebody and you don't have a plan, at least try to put something together yourself. If you need a little extra help, get some help. I would be happy to help you. It would be my pleasure. Hey, thanks so much for watching this video. Hope you guys enjoyed it. Hope it was helpful. Reach out to me if you have any questions.